Dividend stocks helped our challenge portfolio beat the market last year, and I found 3 to buy in January with room to run all year long. In this video, I'll show you how to find undervalued dividend stocks to buy and then reveal those 3 stocks I'm buying right now. We're talking the best stocks to buy in January 2020 today on Let's Talk Money. Beat debt, make money, make your money work for you, creating the financial future you deserve. Let's Talk Money. Hey Bowtie Nation, Joseph Hogue with the Let's Talk Money channel here on YouTube. A special shout out to everyone in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Nation, I loved our 2019 stock market challenge and more than 150,000 of you tuned in to watch the 11 videos in that series. But this year I wanted to do something a little bit different. And we started last January with 10 dividend stocks, almost the entire portfolio, then tracked it all year long. The portfolio did great, but it felt a little stale tracking that same stocks every single month. So this year, we're going to make the portfolio a lot more dynamic. I'll be picking new stocks to buy each month and then dropping a few names along the way. Now, we talked about undervalued stocks in that 12-month plan last week and how those shares that lagged the market last year often get a bounce in January. For example, those shares of Hanes Brands in our last year's portfolio, shares of HBI had lagged the market by 34% in 2018, but had strong upside potential in that e-commerce play and the brand. When investors took another look in January, shares started rising and then just exploded 46% higher after earnings were released. Investors just love coming back to these forgotten stocks in January, and that can really lead to an uptrend higher if those fundamentals prove a good investment. We're taking advantage of that trend now in our first video with these first 3 stocks of the year. Now I'm putting these stocks into my M1 Finance account and we'll be adding to this portfolio each month with some new stocks. I'm using M1 here because of that auto invest tool that's going to make my reinvesting the dividends and the ability to invest evenly across all those stocks in the portfolio with just one click. I'll leave a link to M1 in the description below the video so you can follow that portfolio. So for the 3 stocks to buy in January, I'm looking for companies that lagged the market last year. And not necessarily stocks with negative returns in 2019, but ones that got left behind that broader market surge and could have some value left in the shares. Now I'm also filtering this list for stocks with at least a 3% dividend yield or higher and with multiple years of rising sales. Now that's important, those strong business fundamentals, because you don't want to be investing in cheap stocks that, well, are cheap for a reason. For example, when I screened initially for stocks that just lagged the market and had a 3% yield or higher, I was looking at a couple thousand names, but a lot of these were just going to be pure dog shit anyway. When I added a screen for rising sales year over year and then improving profitability, it cut that list down to just over 100 stocks. What I got was a list of stocks with strong or improving business fundamentals that investors had just abandoned for some reason last year. And maybe it was to look for faster growth in tech or maybe something else, but there was very little financially wrong with these companies that screamed cheap stock, even if that's where the shares were trading at. Now finally, to narrow the list down to our top 3 stocks to buy, I looked for themes and trends that I thought would play out over the next year. These were things like an aging population or 5G or just an end to the trade war, those big picture forces that drive a specific sector or a part of the economy or the market higher. This is the smartest type of investing you can do, investing along with those trends and those universal forces that are going to lift up every stock in a group. Then even if you don't pick that very best company, you can still have that trend pushing your shares higher. And that's actually going to bring me to the question I wanted to ask before getting to our 3 dividend stocks for January. What do you think are going to be those biggest trends in 2020 investing? What are the themes that are going to dominate all year long, whether it's a certain sector like tech did last year or that trade war or just something else? So let me know in the comments section below, what are those themes or those trends that you think I should focus on while following stocks? Now onto those 3 stock picks and why these are going to be those first 3 in our 2020 dividend portfolio. First here is WestRock, ticker WRK, an $11 billion leader in the packaging and container space with a 4.3% dividend yield. Now WestRock has actually been rising since last October, even though it did lag the market last year, and that's something you're going to see in these first 2 stocks I'm buying. We're already seeing some great strength coming back into the price, but still some value in those shares. So the paper packaging market hasn't exactly been on fire lately. In fact, a wave of consolidation has left fewer in the space, and WestRock now controls over 25% of the market. Sales growth is expected in the low single digits, but shares are down 38% from that 2018 high, so there's a lot of value upside here. Shares trade for just 10.8 times last year's profits, though earnings are expected lower by almost 15% over the next year. Now, management has a great track record for beating these expectations, so I doubt earnings are going to be this bad, but they will be lower. Working in WestRock's favor, though, is the fact that the packaging industry has shrank so much over the last few years. So many of the companies have been bought out or busted that the remaining suppliers are seeing better pricing power. The consumer market for packaging is holding up, and the business side could get a boost from that increased trade in the first and the fourth quarter. Analyst estimates range from just $34 a share on the low end to as high as $51 over the next year, on top of that solid dividend payout. Carnival Corporation, ticker CCL, and its 3.9% dividend yield was in our best consumer discretionary stocks video last December 9th, and it's already up 14%, but this one could keep running through the entire year. Carnival beat expectations for earnings by 24% in that fourth quarter call, prompting 3 analysts to upgrade the shares. Now, in that previous video, I pointed to Carnival's dominance in the cruise industry with 42% of the global market share. That's almost double the next largest competitor, Royal Caribbean, and 4 times Norwegian's share of the market. But then if you look at all 3 of these together, that's 74% of the global cruise market, which means they've basically got an oligopoly and can just control prices all they want. Now, when you consider that only 4% of the population has ever been on a cruise, so combine that huge potential for demand growth with a world that's aging into that demographic that just loves cruising, this is a play not only for 2020, but for the next decade at least. The company is set to get 19 ships over the next 3 years, about a quarter of its 100-ship fleet, and this could go a long way to better fuel efficiency and just that increase in supply. Shares still trade for about 11.7 times earnings, which are expected about 3.6% higher over the next year, but management is consistently beating these expectations by about 10% or more. We've got price targets for 15 analysts here, from $42 a share on the low end to $59 per share on the high end, but after that earnings report, I bet we get a lot more analyst upgrades over the next few months. For dividend plays, telecom is a hard-to-beat sector, and Spain's Telefónica, ticker TEF, is a global powerhouse with a 6.3% yield. Now, Telefónica dominates the Spanish telecom market with a 40% control of that market, but also operates some of the largest services in Germany, Brazil, and is a number 1 or 2 throughout much of Latin America. Now, sales growth has been weak over the last few years, but it is improving, and I think we're moving into a very good period for the telecoms. New 5G services and the Internet of Things is going to bring a rebirth in those new phones and connected devices, all hooked into Telefónica's network and pushing cash flow higher. The company has been very aggressive at putting down fiber cable in just about every company where it operates, so that meant some pretty high capital spending. But the time is approaching where it's going to be able to cut that capital spending and start enjoying all the cash flow that comes from it. Now, only 3 analysts here, so it's hard to draw a lot from this graph, but price targets range from $8.21 on the low side to about $9.76 per share on the high end. Check out the video on the right for 5 more dividend ideas and the best consumer staple stocks for 2020. These are some great companies for cash flow, as well as to protect your portfolio. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.